Hello, everyone, and thank you for joining us for another episode of the Financial Commute. I'm your host, Chris Galeski, joined by Wealth Advisor Jenn Caruso. Jenn, thank you for joining us.
Thank you for having me.
So we were having a conversation. You're a wealth advisor here at Morton, and you work with a lot of different clients, our traditional Morton Wealth clients, some of our younger, modern clients that are, building their net worth. But you also have a specialty and background with your degree in Certified Divorce Financial Analyst.
Yes. CDFA for short.
CDFA for short. And this topic isn't always fun to talk about, but there's some real pitfalls that people can run into around planning for a divorce, preparing for a divorce, or how to properly set themselves up for success post-divorce. And I thought we should do an episode, around this topic to not only talk about the misconceptions or misunderstandings that people make, but also things that they can do to best prepare themselves if they're going through this process.
Yeah. And there's a lot of different things that need to be addressed during the divorce process.
Definitely. So let's talk first and foremost about that CDFA, kind of what it means to you and your perspective of having that level of expertise.
Yeah. Great question. And I think a lot of people don't really understand the role of the CDFA. I think most people are familiar with what a financial planner is, and they understand the benefits of financial planning, whether it be college planning or retirement planning, or can I buy the next house, can I move out of state, whatever the goal is. Well, basically a CDFA is a financial planner, but what we're also looking at is how will the divorce impact my future? And so we'll look at, income and post-divorce tax planning. And I will even get involved with recommending how to divide the assets or debts, depending on the situation. And so there are a lot of moving pieces, and every divorce is very different. Yeah. That's what I do. I do not make legal advice. I specifically look at the financial decisions.
So the family law attorney is going to help with sort of the legal advice component.
Correct.
And then your knowledge and expertise is going to help somebody better understand sort of what's there, what's going to be the impact to them, how they can best plan long-term during this transition. As you mentioned, not all divorces are amicable, and some can be very complicated or have a lot of conflict. Let's talk a little bit about things that people should be aware of before they are getting a divorce or going through this process. Like, what does somebody need to do to help set them up for success during this emotional time?
Yeah. When we look at before the divorce, now for the person who is not blindsided and has some sort of preparation, there are certain logistics that can be done. They can start getting organized. They can start their spreadsheet. They can start listing out all of the accounts and account numbers and who owns what. Those are all going to be needed when they have to fill out court documents, right? So get your ducks in a row, put everything in one place where you can access them, start printing out statements. Those are just some of the first steps. They also need to look at bank accounts, and do they need to start opening up their own bank account? Do they need to look at their credit? Do they have sufficient credit on their own? So those are things that they need to start looking at and considering. Once all of those logistics are, started, they're ever changing. But then you can think about, okay, well, how am I going to get a divorce? There are several methods and ways to start that process. And so, maybe you're a do-it-yourselfer. It would have to be a very simple, straightforward. I don't recommend most people do it themselves, but the courts do have a self-help center, and they could do it themselves. If, however, things are a little bit more complex, but still fairly amicable, mediation is usually the most cost-effective option and the simplest. And then we go into collaboration or traditional divorces. Collaboration is where both parties have their own attorney. I would usually recommend this if it's a complex divorce, maybe business owner, there's a business involved. And then, of course, if we get into a high conflict divorce where there's just a lot of fighting and no one is agreeing on much, then you need to go the traditional route.
Which can be challenging. And so let's say somebody is blindsided by this decision and they weren't the one that was sort of in charge of the family finances. Do you recommend going back and trying to get access to last year's and maybe the year before's tax returns so that way you can better understand where maybe accounts and income is coming from? Like what would you say to help the person that's maybe caught off guard by this decision?
Here in California, the courts will look back 2 years on tax docs. So if they are able to, hopefully they file joint returns. If they don't know where the returns are, hopefully a CPA prepared those returns and they could go directly to the CPA to obtain those. In the perfect world, right? They know where the returns are and they have full transparency and access to them.
Because if you don't, then you're likely to go down this process of like, okay, how am I confident that I know where things are, what the values are, and then if it's a high conflict divorce, you're probably stuck leveraging, somebody to go like a forensic accountant to go do some digging. Is that right?
Yeah, I'm always surprised, just a little surprised when people, they don't know where things are. It still happens today, and it is more common than you think. And, if you suspect that your spouse is not being transparent, then I would recommend getting a CPA, a forensic CPA involved.
Yeah, good advice.
Because that really is the only way to get all records.
And so let's say now, okay, you've gone through sort of the before divorce phase. Now you're going through the divorce. This is where the component of financial planning can really come into effect. Let's talk about some of the key components that go into things that people should be aware of and start doing during this process.
Yeah, so, what we want to start thinking about is what is our life going to look like after divorce? What is our income going to look like? What is our spending needs going to be? They're going to change, right? Often people think, I'm going to have a very similar lifestyle post-divorce because I'm going to receive a support payment of some sort. But that's not always the case. So we need to start looking at some cash flow and do some cash flow planning and figure out, what is life going to look like later. And sometimes we need a model, a settlement option or two. Perhaps you're in the position where you can accept a monthly payment as a support payment, or perhaps a lump sum is an option to you. So then we need to model, what is the better decision? If you're the one who has to pay out, whether it be stock options or part of the business or income from the business, those are all things that we need to look at and model and figure out what is the best scenario.
Yeah, I mean, the importance of financial planning, being able to take a look at what assets might be coming to you, where the income would be coming from, a better understanding about what your lifestyle needs are going to cost going forward will help you analyze whether or not you should keep a piece of real estate versus a retirement account versus a trust account and so on. It can get very complicated if you don't have knowledge or expertise in terms of the tax benefits around some of these things.
Yeah, and usually when you're making financial decisions while you're going through the divorce process, it's very emotional, and oftentimes you make a wrong decision because you made an emotional decision. And so we try to take the emotion out of it as best as we can and just look at the numbers and try to make the best decision we can by numbers.
The reason why I think that that's so important is it seems somewhat basic level thinking, but oftentimes my guess is that people are going through this. They have their family law attorney or they're trying to be amicable and do it with their spouse, but they don't have someone on their side that really understands the financial planning and the investment component side of this. Family law attorneys might know this their side of the business very, very well, but they are not experts when it comes to certain types of accounts, the taxes, the financial planning, the income needs, and the investment structure.
Taxes in particular is very important, especially if one person is a business owner. You can run a lot through your business, and your tax bracket benefits from it. So for the person who is not the business owner, post-divorce, they're going to be a little surprised at where they fall in the marginal brackets, right? It could be considerably higher than they realized. So we need to look at that and factor that in, especially if there's considerable amount of pre-tax assets, retirement, defined benefit plans, whatever the employer plan is. We need to account for the new tax rate that person will be in post-divorce.
That's helpful. So as you mentioned post-divorce, let's say they've now gone through this process and they've gone through the divorce. Now the divorce is finalized. What are some tips and recommendations that you have for people kind of post-divorce?
Yeah. This is where you get to, this is the fun part.
Finally.
This is where you get to breathe and just reevaluate where you are. And so we want to look at trust documents, estate documents, what changes need to be made. We also want to look at any kind of life insurance or long-term care needs. If there are minor children in the picture, do we need to make some adjustments there, right? Most of the time we do. So that's definitely something that we need to consider. And then we need to look at, financial planning all over again, right? All right, what are some of your new goals? And oftentimes that's hard for the first year to really kind of decide where do I want to be next year or 2 years from now or 5 years from now. But it's a process, and, that's where the fun starts.
You mentioned in terms of California being a community property state during our other conversations, a long-term divorce, a long-term relationship here in California is what, a 10-year relationship?
10 years.
And so with that comes certain requirements in terms of division of assets, income or alimony or support needs being paid. Talk about that a little bit.
Yeah, so 10 years of marriage, even 10 years of cohabitating, that's considered a long-term divorce, and most everything is considered community property. Gifts and inheritances are usually excluded, but everything else is up for grabs.
Everything that you accumulated together during that time.
Everything you accumulated during the time together, the marriage together.
And then in the past, there were some tax changes as it relates to alimony. What happened there?
Yeah, so effective 2019, if you were getting a divorce after that, you can no longer write off alimony. You can no longer claim, or you no longer have to claim alimony as income. Now that's alimony only. So it is important to make sure that you segregate child support from alimony, because child support is not a taxable income. So be very careful not to throw everything in one bucket, because you don't want to overpay in taxes.
And that's a good point. I mean, I guess prior to 2019, if you went through a divorce, if you're the one paying out alimony, you could deduct that from your income. So
correct.
It felt like you were getting at least some tax benefit by paying that out. But now that has changed, and someone can no longer deduct it from their income, the person receiving it doesn't have to claim it as income
Correct.
as well.
And this is on the federal side.
On the federal side. How about California?
California does allow it up to a certain cap.
Got it. So, like most things, California operates different than we do federally. You've noticed that there are some misunderstandings or mistakes that are made during this process. A lot of it has to do with emotions, and emotions tied towards that family home and foregoing assets or income in order to retain that asset or that family home. What are some other sort of misunderstandings or mistakes that you've seen people make?
Well, the home is the most common mistake. Oftentimes, especially if there are children in the home or even older children, people want to keep the house. So that is usually a topic of conversation every single time I meet with someone. It's not about whether or not you want to keep the home. It's a matter of should you or can you comfortably keep the home. Even people with great wealth, they have homes that are quite expensive.
Yeah.
And so it's not, even if the home is paid in full, right? Can you continue to maintain that home comfortably on your new income? Because your income is going to be cut in half, most likely, at least. So we do need to look at, some other options there. One thing that I suggest to people is to consider a leaseback. Go ahead and sell it, get your exclusion now, lease it for another year or two. Yes, it's more expensive in the short term, but that gives you a little time to transition. But, that would be a consideration. Also, it depends on whether or not the home is paid in full and if there's enough post-tax assets to offset that. But, can you restructure the ownership and continue to own it jointly for investment purposes? That's something to consider. But you really have to do the numbers to really decide, is it feasible?
And I'm sure in an environment like this where people that had owned a home for a decent period of time that maybe have a really low interest rate on their home, if they were to have to sell that and go buy a new home or rent a new place today, just basically where interest rates are today compared to where they were just a few years ago, that ties into the emotional component as well, because the affordability could be quite different. You might be going from a 4,000 or 5,000 square foot house to a 2,000 square foot house just because of how much more expensive not only the value of the homes are today, but the cost of borrowing.
Yeah, and it is a very emotional trigger for many people that they have to downsize or right size or whatever you'd like to call it. There are a lot of things during the divorce process that seem unfair, but it's part of the process.
Jenn, thank you so much for talking about this today. I know it's not sometimes the most fun topic to talk about, but it's one of those life events that us as financial advisors can be there for our clients. When you think of loss, when you think of divorce, when you think of job transition, that's the role that we're able to step in and be that partner with our clients to help guide them through these waters, to understand the impact that it's going to make to them long term and how we can best set them up for success.
This is life.
Yeah.
And this is life planning. So,
I mean, there's some statistic that over 53% of all marriages.
I wasn't going to spout that statistic.
Yeah. I think it's 53. I might be wrong.
In California, it's over 53. It was 50.
Yeah.
And unfortunately, second marriages have a 60% ratio of divorce. So it is something that we have to address. It is something that touches our families one way or another.
Yeah. Thank you so much, Jenn.
Thank you.